If we get eightfold, it just did what we did twice before for reasons that were far less dynamic and significant to the world fundamentally than what we've got now. You'd be at $8,400 or so just to match what had occurred before. So when you look at the current price chart, you think, oh my God, look how ballistic it is. When you put it on a logarithmic scale chart as we're showing, it's just getting started, guys. We're not even halfway up to the gains we saw in those two bull markets. We're not even fourfold yet. So that's something to consider. I don't trade off of it. Maybe we're not going to go eightfold again, but considering the dynamics that are out there in other markets, either way, upside or downside, it would be easy to see gold at least matching what it did then. So don't think gold's overpriced.
Gold's history shows a rhythm that few investors grasp until it's too late. Michael Oliver points out that since Americans were first allowed to own it again in 1975, there have been two defining bull runs: 1976 to 1980 and 2001 to 2011. Both times, gold surged roughly eightfold from its low to its peak. The last major bottom came in 2015 at $1,045 an ounce. If history rhymes, an equivalent eightfold move would carry gold to about $8,400. And here's the kicker: today's global financial conditions are far more unstable than in either of those earlier periods, which suggests the current rally could still be in its early innings. Silver tells an even more explosive story. Oliver looks at it relative to gold, not in isolation. Over the past half-century, silver has repeatedly returned to a level where its price equals at least 2% of gold's price. That threshold has been reached 21 times in both bull markets and flat years. Right now, silver sits at just 1.16% of gold's price, meaning it's trading at a steep discount to its historical relationship. The math is simple. If gold stabilizes at $4,000 and silver merely reverts to its 2% norm, silver would be near $80. If gold pushes to $8,000, silver's 2% share would mean $160. History shows silver often overshoots even that, as in 1980 and 2011. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Yeah, right now, if you look at a monthly price chart, just a regular arithmetic scale price chart, and I'll go back to 2011 high, and you had the drop into 2015, 50% drop. And from 2015, you worked your way up, but it was an arm wrestling process. In fact, there was 120% correction in there between the early 22 high and it was August 22 low. He went from 2000 down to 1613. Okay, pretty nice drop, 20%. And then you reasserted yourself, but it was an ongoing, arduous process. And only now has it started to look like it's accelerating. And so if you looked at a bar chart of weekly or monthly gold, and you're an average investor, you say, boy, that's been glorious. I'm glad I was in that. And you're thinking, God, it can't go forever like this. But when you look at a ratio scaled chart, in other words, percent gain of a bull market, and go back 50 years when the government approved it for us to trade, God bless them. You've had two bull markets. There were eightfold moves from bear low to bull high, different duration of time. One was from 76 low to 1980. The other was from 2001 low to 2011. But they were both eightfold multiple gains for gold. We bottomed at 1,045 in December 2015. If we get eightfold, it just did what we did twice before for reasons that were far less dynamic and significant to the world fundamentally than what we've got now. You'd be at $8,400 or so just to match what had occurred before. So when you look at the current price chart, you think, oh my God, look how ballistic it is. When you put it on a logarithmic scale chart as we're showing, it's just getting started, guys. We're not even halfway up to the gains we saw in those two bull markets. We're not even fourfold yet. So that's something to consider. I don't trade off of it. Maybe we're not going to go eightfold again, but considering the dynamics that are out there in other markets, either way, upside or downside, it would be easy to see gold at least matching what it did then. So don't think gold's overpriced. If you look at that chart, what it shows is pick monthly close each year that was the highest close of the price of silver relative to gold. And we calculate that by simply dividing an ounce of silver into an ounce of gold, express it as a percent. So you see the scale on the left goes from like, 0 up to 7 or 8 or whatever. And you see these bars, the highest reading you had each year. The lower horizontal line on that grid chart comes through at 2%. 21 of the past 50 years have reached 2%. Right now, we're about 1.16%. Okay. We're very suppressed, very depressed relative to that norm. Okay. And in bull trends, when silver gets going relative to gold, like 79 to 80, 2010, 2011, the spread got up to 3.5%. And back in the 1980, got up to 6% plus. Okay. So just getting to a routine, been there before 21 times in the last 50 years, many of those years not even bull trends, I'd go to 2%. Well, that's nearly a double of the current valuation of silver to gold. What usually happens is when that spread breaks out, and you can't measure it that well on that graph we're looking at. But when we take it down to week action or monthly close to monthly close, and we do an oscillator, a momentum study of the spread, not just looking at the spread, we can see a breakout level not far above where we are right now that says we're going to gush. We're headed sharply toward it. In fact, since April, the silver gold spread has shot up pretty nicely. Silver is up much more in the year than gold is, by the way. Okay. So it's catching up. But there's a breakout level on that spread that says, I'm going to launch. And we define the number in our weekend reports. Once you trigger that, you're going to gush up at least to that 2% level. Probably even further, but let's just say we go to the norm, 2%. Again, that's nearly a double from where you are now. Well, if gold went dead sideways at 4,000, let's say, and silver went to 2%, you do the math. Okay, $80. If silver goes to its norm, gold goes to its normal eightfold bull trend, and let's say it goes to 8,000, which it's done twice before, remember, in terms of ratio. What's 2% of 8,000? Okay. Silver is also well below its 2011 high. The miners just took out their 2011 high. GDX, XAU. Gold's way above its 2011 high. And even a bloody base metal, copper, is currently trading above its 2011 price high. Is silver going to stay a dog forever, or is it a mistake? And you and I know, being in markets long enough, you'll find markets that get excessively overdone on the upside and are making a mistake, and other markets that get excessively cheap relative to other assets on the downside, and are ignored until finally they wake up and you say, golly gee, I wish I'd realized that. Whoosh. And silver, our argument is, the technicals argue to us, silver between now and the end of the year, in all likelihood, is going to gush past 50 and be in somewhere in the 60-70 range.
Gold's price action this year has been a lesson in patience. Michael Oliver notes that after spiking to about $3,400 in April, the metal went flat for nearly 5 months. Traders kept calling a top, but what looked like exhaustion was really just consolidation. While gold chopped sideways, the real action was elsewhere. Miners surged, and silver quietly slipped out of a year-long range, leaping from the mid-30s to around $43 in just a few months. Gold barely moved, but the groundwork for its next leg was being laid. Oliver points out that a key driver of this strength isn't retail traders but institutions. Large asset managers, most of whom don't think of themselves as gold enthusiasts, have started carving out tiny allocations, 2 or 3% of portfolios, into miners. That may sound small, but in a sector this thin, it has an outsized impact. Names like Newmont have gone vertical, not because of a flood of individual buyers, but because institutional money is finally noticing. The mining sector is so small relative to global capital pools that even minor shifts behave like a fire hose hitting a teacup. Oliver's takeaway: gold's pause is ending, silver has already fired the starting gun, and miners are riding institutional momentum higher. Let's get back to the interview.
I understand from various bank reports that I've read or heard about of analyzing their customers that are invested in the market and have an account in the bank that does that. The use of leverage has never been higher than it is now, and yet it's persisting. Okay, so you can make an error, but keep making it, and the longer you make it, the worse the consequence probably. But again, the issue is when. Okay, yeah, it's a reality; those are objective facts. But again, when, and that's what we're focused on. And I do think it's a key factor right now because when it does crack, we know what's going to happen to the central bank. They're going to go berserk, even more so than they already are. Um, which case they'll lower rates, but they'll also increase money supply, et cetera, et cetera. But and that will impact other markets as well, because when they push the throttle, especially gold and the monetary metals will accelerate even further. Not that they're dependent on it, because they've already anticipated that event. Money's already started to flow. Not particularly American money, by the way, but other parts of the world have gone into the monetary metals. Wait till that starts. I think it's already begun, and I think that's why you've seen gold miners go vertical, especially since April. Remember, gold made a high in April when we interviewed last time. Gold was up to, I think, 3,400, and it went dead sideways for 5 full months. They sold it, and they sold it, thought, oh, this is the top, this is the top. It wasn't at the top, it was just a sleepy range. What happened since then? Miners exploded while gold went sideways. Silver went from mid 30s, lower 33, 34 area for a year. In fact, it had been, in fact, in last May of 2024, it was up to 32.70. So you could draw a line across that high through the next year of action, and you did this on either side of it. And it wasn't until late June, July, you finally went through the highs. So July, August, Sep, oh, boom, silver goes from mid 30s to what? 43. Okay. So while gold stood still. Now gold's starting to reassert itself here. But I think that money flow that went into gold miners was from asset managers, largely the larger ones, especially Newmont, which has gone vertical for the last few months, uh, who've decided, hey, they know the stuff you just mentioned. Too many points of excess. I think I'll move 2-3% into the gold miners. They look undervalued. Gold's been doing good. No, I'm not a gold bug, but I'm gonna move some money over there. Well, when they do, it's wet bar of soap time. Squirt on the upside because it's such a small sector. And I think that probably some of the power that's driven that is the doubtful asset managers in the stock market. Can't prove it, just an assumption. Dollar index made a high at 115 back in 2022. It was still low compared to decades ago. Okay. It dropped sharply into 2023 down to 100 area and went into a dead range 2023, 2024, and early 2025, 100 to about 108. They had one spike up to 110, but basically most of the action was in about a 7 to 8% range for 2 years, which is very dull, almost non-eventful. A lot of other markets were making big moves. It wasn't. It was not a factor. When it turned down from early highs this year and got down to 104 again, actually 104.21 was the close of March, we turned major bearish. Price-wise, you're only in the middle of the prior 2 years range, but momentum said you're gone. So momentum broke. Price didn't yet. Annual momentum of the dollar broke trends that went back 10 years, sometimes more, went to the 10-year average momentum of the dollar, which is even a longer term yardstick to measure momentum. Even longer back, you broke a beautiful uptrend line that you could see on momentum, you cannot see it on price. On a price chart, what's been going on since that drop from March to April, once we made a low in April, by the way, which was coincident with the stock market low, dollar dropped sharply with the stock market. The dollar tried to bounce with the stock market, and it went into an up-down range from the low of April, below that level and above that level, 4 or 5 point swings. And every rally, everybody said, oh, the dollar's looking good. There was an uptrend line on a price chart of the dollar that goes back a decade that any idiot with a crayon could draw, and they did. And they've been buying it since the April low along that uptrend. Momentum says it's not going to hold. We're back now this week. We've traded back under 97 this month, back down to the lows of the move again. Now, I don't think you're going to hold this time. And when the price guys finally realize, oh, my trend line's not holding, let's say you close a month out at 96.50 or 96, just a little below where we are now. They're going to realize, oh, we made a mistake. That line didn't hold. Well, momentum already says it's not going to hold. We think you could go down into the 70s again, if not make a new low, below the low of a decade and a half ago, which would create turbulence in other asset categories. Like you've said, we've dropped, we've been bearish since 104, so you've dropped a pretty good number of points, but it's really not that earth shaking. The next 20 points could be earth shaking in terms of wave effects. And that's when it'll start to impact other markets that up to now haven't been impacted severely by the dollar's movement. And again, this isn't real dollar value. This is dollar value versus other pieces of paper. Yen, the euro primarily, and the yen, they constitute 70% of the dollar index.
What ties all of this together is the sense that gold and silver are not just drifting higher, but following a historical rhythm that keeps repeating in larger waves. The pause in gold after April's spike looks less like exhaustion and more like the kind of breather that has marked the middle of past supercycles. Silver, with its tendency to snap back violently when it lags too far behind, is already hinting at what comes next. And the sudden appearance of big institutional money in miners shows that this cycle isn't being fueled only by small investors chasing momentum. It's deeper than that. If the past is any guide, both metals still have plenty of room to run, and the institutions entering now may just be the opening act, not the finale. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.